those types of things, most banks want to work with those borrowers, right? So
Sure.
it's really the strength of the borrower, the strength of the sponsor or the operator, which is really predicating what's going to happen over the next
Yeah.
year or two or three, right? The
Sure.
sponsors that
Sure.
have thick, I'm from Minnesota, so the
Yeah.
sponsors that have thick ice underneath their feet are the ones that are going to be able to survive
Survive.
without
Yeah.
having to turn the keys back over to the bank, right? Without being in a
So true.
position where they know they're going to lose a portion or up to all of their original
The
investors'
equity.
capital in those deals, right? But there's
Right.
also sponsors on the other side of that equation that may never come back because the ice was so thin under their feet. They were so over leveraged, right? They
Yeah.
weren't
Yeah.
liquid enough. They had brand reputation crises on their
Yeah.
hands from existing investors because of lack of transparency in most cases, right? Investors were just caught off guard, that the property was bleeding cash. And it wasn't
Right.
until they almost
Yeah.
lost the deal that the investors found out. So that level of trust and transparency, in this space is incredibly important. So where do I think we go from here? Well, I can tell you that I've been in attack mode, as I told you before, as a limited
Yeah.
passive investor. I've doubled
Yes.
down because we're in a point in the economic cycle where most of what I'm investing into today is at a 20 to upwards of 40% discount from what that property would have sold for in
Yeah.
21 and 22. So the basis is much lower. Okay.
Much lower.
Well,
Yes.
we're at
Yes.
a down cycle. I don't know if we're at the bottom. I don't know if we're starting to swing up again. Okay. I'm optimistic about the future because of supply demand absorption,
Yeah.
where we anticipate interest rates to be, even if they don't
Maybe two
continue to
cuts.
go.
Maybe two
Yeah,
cuts
we'll,
this
we'll
year. We
see.
don't know.
No,
Yeah.
no, no, no
Yeah.
promises in any
No
of that, right?
promises. Yeah. Yeah.
But if you zoom the lens out far enough, right? What happens in real estate? It goes up and to the right over time. Okay. Zoom
Correct.
the lens out over 10 years, zoom it out over 25, zoom it out over 50, 100 years. It's always going to go
Yeah.
up and to the right. But you're going to
Yeah.
have times during that time frame, right? There's going to be economic cycles, right? Where
Yeah.
there's going to be
Certainly.
times where valuations are going to decrease because
Yeah.
of the glut of new supply, because of the cost of debt service, right? Because of higher property taxes or insurance costs that maybe weren't projected or predicted, on the front end when the operator acquired the asset. So all of these things that I'm trying to explain all point back to one thing and one thing only, okay? And that is, as an investor, you're not investing in the pitch deck. You're not
Yeah.
investing in the highest IRR. You're not investing
Yes.
in the business plan, the property, the location. You're
Yeah.
investing in the operator and their ability to reduce and mitigate three things. Number one, operational risk.